Hi, everybody. Welcome to week 4. We're going to focus on forecasting this week. Hopefully you've had a chance. I would really encourage you to work through the examples in the book as well to help give you the background. And hopefully then I can, yet again, walk through some of these models with you, but also put into perspective and context where and how we might actually use these. Now, if we look at really mature companies, so looking at a company like Apple and trying to understand how they do forecasting, it is very sophisticated. It is far beyond what we do in the course of this class. And really, it's done by probably a number of mathematicians and probably some people doing operations research as well to try to create models that are going to be most accurate. So there's an entire discipline. You can do an undergrad and graduate degree and even a PhD in creating some of these forecasting models. But my intent for what we're going to cover within this course and really just within this week is to get a good understanding of what forecasting is, the different scenarios that we have to consider in terms of where the company is in terms of growth of the product, maturity of the product or service, and really understanding whether there's a trend present or seasonality, and all of those things are going to factor into what type of model we look at for understanding our forecasting. And while huge companies like, Apple and like Amazon have these really sophisticated methods for forecasting, oftentimes with smaller to mid-sized organizations, forecasting is done. But typically, if there isn't a piece of it that's being kind of outsourced to a third party or a consultant, there's typically some opportunity to do improvement with forecasting. And it is very important to helping plan for the future, making sure that you're bringing in staffing accordingly, you've got the right equipment and resources to be able to meet the demand. So this is a pretty recent poll. So this is looking at sales of iPhones for Apple from 2007 to 2017. And it's really interesting, and I think it sets the stage for how we think about the models we use. So if you were to look at this data, do you think it would be worthwhile for Apple to consider taking a simple average to predict what 2018 forecast for iPhone sales would be? Probably not, because we know that a lot has changed. Clearly, it's ramped up over the course of the past 10 years. So what we might want to do is actually, if you looking at this graph, it certainly seems like 2015, 2016, and 2017 are all in the same range. Maybe we can assume that in this case that the demand is sort of stabilized for Apple iPhones, and we might just want to look at taking an average of the past 3 years. That would be a moving average. Now, we might also want to consider, we see that, it went down a little bit in 2016, up again in 2017. We could consider, in this case, again, this is a very simplified example because I'm sure that there's really a very sophisticated model for how they're actually creating their 2018 projections. But you could look and say, well, we think there's going to be a downward trend, and we think we'd like to give more weight to what we saw in 2017 and maybe even 2016 as opposed to 2015. So that's something that we'd call a weighted moving average, which is basically just giving weights to the more recent periods. And if you pick only a few years, that would be a K period weighted moving average. So again, we'll talk through all of this a little bit more. But I think this is good to be able to visualize when you're looking at the data and understanding growth of a product or a service, trying to understand which sort of forecasting method is going to work best. So a couple, I think, some really interesting companies. Again, these are above and beyond probably what we'll be doing, as you go out and work at your organizations. But a few companies that are really interesting in terms of their forecasting models. Certainly Amazon. Actually, Amazon in the past year has done some amazing things. If you have a chance, go out and look at the Amazon SageMaker. It is a new service line offered through Amazon Web Services, and they have some of the most sophisticated forecasting models that they not only use themselves, but they actually now provide this service and these forecasting models to other companies, obviously for a fee through their Amazon Web Services portal online. But it's really fascinating. The things that they found, they use machine learning, which basically means that their algorithms are continuously getting better and getting more accurate. And we'll talk a little bit about this too. If you can find this article that I'm referencing, and it does go through all of the things we'll talk about in this class, the basics in terms of they do use the basics of time series models. They do use some exponential smoothing models. And we'll talk about these smoothing constants, alpha and beta, if we've got a trend in our data. And basically the models that they're using are, a much more involved version of exponential smoothing with trend adjustment, but it's also capable of bringing in historical data. It's also capable of bringing in these external factors in the environment, so some associative forecasting methods and looking at some regression models as well. But it's fascinating just in terms of being a leader in this industry. It's maybe not something that you considered Amazon was, that they were offering these services to other companies, which they are. It's been really interesting because up until their release of SageMaker in the past year, Amazon has already done some pretty interesting things in terms of seeing how long people are hovering over certain items and doing projections for seasonality for certain items, and all of that, even the time that you're spent kind of looking at a certain item, the time you're spent with your cursor hovering over it, or indications are all built into Amazon's forecasting model and actually helps them predict what you're going to buy before you buy it, and goes into how they think about staffing at their fulfillment centers. So some really interesting stuff they're doing. Apple, as we saw the example, just looking at iPhone sales, it'll be interesting to watch because with the release of the iPhone 10, Q1 projections or actual demand was a lot lower than expected. So it'll be interesting over the course of the semester to see how they recover and how they kind of come back or kind of refine their approach and their strategy for the iPhone 10, given the lower sales number in Q1. Disney is an example, and I think this example is in the book as well, of a company that has a daily forecast, which is dependent on a number of factors: time of year, day of week. It gets into taking into account weather patterns, what conferences are going on in Orlando. So bringing in a lot of different metrics into the equation. I have students in the classroom section who have done work at Busch Gardens, and all of these major theme parks are forecasting by the day, and it's not something that is just being reviewed by senior leadership, but it's actually communicated to the people who are in the park for them to get an understanding of what demand is going to look like in the park for the day. So again, this is above and beyond what we'll do in the course of this week in talking about forecasting, but it's interesting to really understand what some of these companies are doing. So on a smaller scale, for those of you that have small businesses, there are a number of software programs that you can actually use. I've used Insightly before just to track sales, and depending on how you have it set up, you can have inquiries come in, and you can try to make projections based on those inquiries. You can look at seasonality of the data in terms of request for a product or a service over time. So there are a lot of smaller scale software programs that can help you do forecasting as well. So as we think about forecasting, there are three main time horizons that we want to consider. Obviously, a short range forecast, which is just looking out a few months in advance, and this is more so for staffing and making sure that you've got your inventory levels are okay and that you've got the right staff to be able to meet the demand. Medium range forecast is anywhere then from 3 months to 3 years, and long range is looking out further than 3 years. And you might want to do that if you're looking at purchasing a new facility, making a major renovation or capital expenditure, or even if you think that you might want to sell your business at some point, you would want to be doing those long range forecasts to understand not only what forecasted demand is over the course of the next year, but based on inquiries and from different markets, what can you project about that demand in the future? And that, of course, would all be really important when putting a valuation on a company. One of the things that you would also want to include in terms of doing forecasting is we want to consider where you are in the product or service life cycle. So is it something that's just being introduced? If so, you're probably going to have some really subjective and qualitative forecasting methods. If you're in that growth phase, that's where getting those good forecasting models, those quantitative models together is really important as you grow. As you're in that maturity phase, if demand is relatively stable, hopefully you won't have to put as much time and effort into your forecasting models, but you also want to do forecasting when you're starting to ramp down a certain product or service offering. It's going to be important then, again, to kind of build that into the overall forecast for the company, because typically we don't want to do forecasting just for all Apple iPhone sales. Of course, we want to have a forecast for every single model, even the iPhone 7, which they're still selling at a reduced rate, and how that would impact sales, revenue for the company as a whole. A good Fortune.com article that came out in January 30th of 2018 that kind of goes through and describes the predicament that Apple is in terms of the release of the iPhone 10 and its price point and what that means for, how they're going to approach it with maybe some sales or some incentives for their other model lines. So all important things that you want to consider out when you're trying to figure out the appropriate forecasting model. So just a quick check. When it comes to forecasting, we know that they're always wrong. What we want to try to do with our forecasting models, and especially in this week, and you will see this on the test, is we want to try to determine what is the most logical type of forecasting model to use. Maybe there are a couple that might make sense. We want to try to figure out which one is going to be best. We want to practice with it, and we want to see which one is going to give us the lowest forecast error. So our goal is not to be perfect. That would be wonderful, but forecasts never really are. We just want them to be as close to accurate as possible. So there are a number of forecasting approaches that I won't go through in detail. You can find these in the text, and they're really useful, again, when you're kind of in that initial phase of creating a new product or a service, or even in the growth phase a bit. And it's going to be important to bring in experts from the industry, people that have kind of seen or done some market analysis on how different service or product offerings have gone. You can pull in all of that subjective information, but again, this is more useful for smaller companies, and especially when you're really just starting up. Once you get that historical data, even if there's uncertainty in the environment, you want to be analyzing it, because that's going to be, giving you some clues as to whether or not there are trends in demand, or whether or not there's some seasonality that needs to be taken into account. So the quantitative approaches that we'll focus on for this course, the majority of them are time series models, which basically means you're using historical data to determine what your forecast will be in the future. And those are things like the naive approach, moving averages, exponential smoothing, and some trend projections. And we also have associative models, which are basically fitting a line, doing some regression analysis, but instead of looking at historical data to understand what our forecast will be, we can look at other things that are happening in the environment. We can look at housing sales, we can look at salaries, we can look at economic upturns and downturns, and try to understand how those factors in the environment are influencing our forecasting decisions. We might also want to look at sales of our competitors that might impact our forecast for our products and services as well. So again, these are when we talk about quantitative approaches, we really break them down into time series and associative models. So first and foremost, the naive approach is called the naive approach because it's pretty basic. All we do is we take the actual demand from the previous period and assume that that's going to be our forecast for the next period. This is great, again, if you're just starting off and you're not really sure where to start with your forecast. But of course, it's not going to be something effective that you can use in the long term unless your demand is extremely stable. If you've got extremely stable demand, then forecasting is not going to be as important, and you can probably use something as simple as the naive approach. Another method is the moving average, and it is, again, used if there's really little or no trend. So if you've got stability in demand over time, we use it to smooth the data. So if we do see some little fluctuations in the data, a moving average is good at kind of, again, smoothing those out. So all we would do, so in this case, if we wanted to take a 3-month moving average, we would take the actual sales from the 3 previous months. Here you can see January, February, and March. We would add those up, take the average, and that's going to give us our forecast for April. So fairly straightforward, and you can do that on an ongoing basis. Again, like we talked about with the Apple example, we can use a weighted moving average. And this is more effective when we think that there might be some trend present, where we want to give more weight to the most recent period. So again, if we did a 3-month weighted moving average, what we would do is we take the last 3 months. Here, we would multiply March. Let's say we want to give that the most weight. So we could multiply that by 3. We could multiply February by 2. And then we could just multiply January by 1. Now, we have to take into account these weights when we do our average. So we've got 3 plus 2 plus 1, that's 6. So we're basically multiplying these values 6 times. So we want to divide by 6 as well. So that'll give us our moving average, our 3-month weighted moving average, which again, very similar to the regular moving average, but now we are giving more weight to the most recent period. So one of the problems with the moving average is that as your N increases, if you want to take throw a wider net in terms of bringing in more time periods. It will help smooth your forecast, but it makes it less sensitive to changes. It also can be a little bit cumbersome in terms of a smaller company trying to do this data on a regular basis. If you've got a good Excel chart, set up, it might be easy enough to do, but it can be a little bit time consuming and does require that you do keep really good track of all of your historical data. So we can see here, sometimes it's nice to just look at it graphically. If we look at actual sales, and we can see here that there's certainly, it seems like there is a trend present. It seems like there's also some seasonality that's at play here. So if we look at these values, if we just did a 3-month moving average, then we're going to see that our forecast here for April is going to be about 10. If we do the weighting moving average, we're going to see that, again, it's going to give more weight to the most recent period. So we're going to see that that's going to be a little bit higher, maybe around 12 or so. So we see that, the weighted moving average in this case, because there is some trend present, it's starting to move a little bit. It's going to give us a more accurate forecast, but it's not great. And it does lag a little bit behind the actual sales. So one of the things that we can do is another model or quantitative model called exponential smoothing. And this is one that we're going to use when, again, we think that our demand is going to be relatively stable over time. And it's going to use a smoothing constant, alpha, which ranges from 0 to 1, which basically tells us how much weight we're going to be giving to the most recent period, which is great because even if you have all of this historical data, you're really only pulling from the past period for the sake of creating the exponential smoothing model and calculating it over time. Because all of those previous historical data forecasts are actually being pulled in constantly into the most recent forecast. So in some way, it's actually providing weights to all of those historical values as well, but you don't have to keep track of them. So the way you do this is the exponential smoothing formula is our forecast for time period t, so for our next year, let's say. So forecast for next year equals the forecast from the previous year plus our alpha value, our smoothing constant, all multiplied by the actual demand from this past year minus the forecast from this past year. So a very simple example, let's just say it's a car dealership and we're using an exponential smoothing model. So if we say that the predicted demand for this month is going to be 142 cars, our actual demand, for let's say the last month, predicted demand was 142 and the actual demand ended up being 153. And let's say we choose a smoothing constant alpha of 0.2. That means that a lower value is going to give us kind of assuming that our data is going to be more stable over time. So we're just looking for kind of a smooth forecast, and we're not going to try to chase all of the fluctuations in the data that we might see. So in this case, our new forecast would be our predicted demand from this last period would be 142 is our forecast plus 0.2, which is our alpha value, all multiplied by our actual demand, 153 minus 42. So that's going to give us a forecast for the next month of 144 cars. Okay, and that again is using an alpha value of 0.2, which when you're doing this in practice is something that's subjectively chosen, but really the point of it is getting started, choose something, try running a couple different models, and then we'll use forecasting error to figure out which one is going to work best for us. So again, when it comes to the smoothing constants, you're going to want to choose a higher level of value of alpha if you really want to try to chase those changes in the data. Depending on what type of business you're in, that might make sense. Other times we just really want to have a smooth forecast over time, especially if our forecast is influencing our staffing patterns and we can reasonably account for, managing some of the fluctuations in demand given the staff that we have. If you really we're trying to chase some fluctuations in the data, you might be changing, adding, or removing people from the staffing pattern, which might make it just more difficult to do in practice than it's worth. So just things to consider depending on what type of organization you're working in. So here's what this looks like visually. So if we've got the actual demand in blue, and we definitely see that there are some fluctuations in the data here. If we use a smoothing constant of 0.1, our forecast is going to kind of stay right in the middle there. It's going to stay pretty consistent. Whereas if we choose an alpha value of 0.5, it's going to start following is going to start following that demand a little bit more closely, again, because we're putting more weight on the most recent period. Again, choosing alpha is a subjective thing, but we want to trial a bunch of different forecasting models, and also if we're using just exponential smoothing, you can run exponential smoothing models with excuse me, different values of alpha to figure out which one is going to be the best and give you the least error in your forecast. So when we talk about forecasting error, there are 3 common measures that we use. The first one is the MAD. You will see people actually do use mean absolute deviation to calculate forecast error. All you do in this case is you take the actual value of demand that you saw in the last period minus the forecast. You do that for all of your historical data. Take the average, and that's going to basically give you that mean absolute deviation in terms of how far off were you with your forecasting model. So in this example, if you've got actual demand here for each quarter, and we've got our forecast, we've got 2 of them. We've got a forecast using exponential smoothing with an alpha of 0.1, and we've got a forecast with an alpha value of 0.5. We're going to go through here and do our calculations and create our forecast for all of the future quarters, and then we can compare those forecasts with whatever that actual demand was. To do that, again, to calculate the MAD, we take that actual demand, we compare it to our forecast here, the absolute. We're going to take the absolute. We don't care if it was above or below. All we care is how far off of that forecast was it. So we would take the absolute deviation, or the absolute value of the difference between these 2, add those all up and average them, and that's going to give us a MAD of 10.31 for an alpha of 0.1 and 12.33 for an alpha of 0.5. So in this case, it's indicating to us that the alpha value of 0.1 is actually giving us a more accurate forecast because the forecasting error is lower for that forecasting model. Another one we could use is mean squared error. We typically use this if we're in a situation where it's detrimental if we have a really huge variance. Whenever we square something in a formula, it basically is taking those errors that are bigger and it's just magnifying them even more. So this would be a great example would be if you're working in a theme park, and this is the case one of the students had mentioned at Busch Gardens. They had received the forecast for the day that there were going to be 15,000 people in the park, and that day there ended up being 30,000 people in the park, and it was just absolutely chaotic. So that's an example where, depending on your industry, that could completely throw off operations for the day, and there could be some really bad outcomes. But if you're working in a facility where if demand was twice as much as you expected, but you have a lot of inventory, or you have someone in your supply chain that can restock whatever you need, it might not be that devastating. So this would be a model that would really highlight where those larger forecast errors are. And last but not least, another one is the MAPE, the mean absolute percent error. A lot of companies will use this because as a value, it just seems to make more sense. So when you run this calculation, it's going to give you the percent you were off with your forecast based on what the actual demand was and what your forecast was. Again, all 3 of these types of forecasting error calculations are going to tell you, if you're looking at several different models, they're all going to give you the same answer in terms of which one has lower forecast error. It's just the only difference is really how are you going to be using them? Are your team members, are you going to be indicating to other people in the organization how well your forecasts are doing? If so, the MAPE is better because percent error is typically something that people can wrap their head around a little bit more easily. Again, forecasts are always wrong, but our goal is to evaluate a number of different models, and using our forecasting error methods, determine which one is going to give us the lowest forecasting error.